Student loans in Australia can be confusing. Most domestic students finance their study through the HECS Help system, which involves taking out a HECS debt to pay for the student contribution to their studies. However, this system can be a little bit confusing and a little bit opaque. Various terms fly around, such as indexation, for example, and has become a major issue when students realize the debt ballooned following indexation, when it increased due to what was going on with inflation. And this therefore begs the question of exactly how does HECS debt work? Are there any advantages to paying off the debt early, and how does indexation work? That's what I'm going to be looking at in this video. Now, I'm an associate professor of finance at UNSW, and this topic comes up actually surprisingly frequently. But if you've got any thoughts about the HECS system, well, let me know that in the comments below. And otherwise, let's dig into it. So let's start with how the HECS debt system works. Well, the HECS debt system involves facilitating your payment for the student contribution to a subject. So to make that clear, when you enroll in a subject at university, there's a cost associated with it. Now, the cost is paid for by two overarching groups. Firstly, you've got the government paying for part of it, which is coming directly via funding from the taxpayer, and the other part of it is funded by the student contribution, which is what you would need to pay when you enroll in that subject. Now, you have two overarching ways of paying for this. You could either pay for it upfront, either in full or in part, or you could take out a loan in order to pay for it. The loan would come via the HECS Help system, which I'll just call the HECS debt at the moment. Now, HECS debt is only available to domestic students in general terms, usually Australian citizens, some New Zealand citizens, and some people on other visas. You require a taxpayer number in order to be able to get access to the HECS system, but most people will have access to that. Furthermore, you need to lodge the application before the census date. Now, for a student enrolled in the university, they can only take on so much HECS debt. They have a limit to how much they can actually accrue, meaning you can't just go and study subjects forever without paying it off. You have a limit. Now, that limit will increase over time. At the moment, the limit is about $113,000. But like I said, that would increase with the costs and associated indexation. Now, the actual amount that you borrow is also indexed, and I'll come back to what indexation means in a second. But in short, that means that say you borrow $5,000 right now, that $5,000 number will increase over time with inflation, meaning your debt will increase over time if you are not paying it off. This, in other words, is rather like capitalizing interest on a loan. But like I said, I'll come back to what indexation involves in a second. Now, in terms of repaying the loan, well, basically you need to do this if you are earning more than the set amount of money. If you are earning under that set amount of money, you don't need to repay anything. Now, the way this operates is say you're earning over that threshold. Well, then, out of your payslip, money will be taken to pay for your HECS debt. You would need to inform your employer that you have a HECS debt, and then the money would be taken out automatically. Much like tax is taken out from your PAYG payslip, this is done automatically. If it is not done automatically, for example, the HECS debt would not disclose to the employer, then that is going to come back to you when you are filing the tax return, and you'll need to pay for that HECS debt. Now, at the moment, the threshold at which you need to start paying is about $51,500. In the prior financial year, it was $48,361. The threshold will increase due to things such as indexation. Now, like I've indicated, the loans and the payments are typically operationalized via your employer. However, you can also make voluntary payments via the ATO's tax portal, and you can make a voluntary payment at any time. You can just go into the tax portal and make a payment. There's no need to actually wait to do so. Now, as I've indicated, after you're earning over a certain amount of money, you are required to start making payments toward that HECS debt. You are required to start paying it off. And this scales up toward making a 10% payment every year. So for example, say you're earning $51,550, then you need to make a 1% payment of that debt every year. But if you're earning over $151,000, then you make a 10% payment to the debt in that year. So the exact amount of payment you need to make will vary with your income. However, as we will see, it is always desirable to pay more than the minimum if you are at all able to do so. Now, there are ways that you perhaps reduce your payment. For example, if you are suffering from financial hardship, which might arise if someone has illness or misadventure, in which case you would need to contact the ATO in order to let them know that you're suffering from financial hardship in order to make amendments to the payments you would otherwise be making. However, bear in mind, your debt will still be indexed and will still increase with inflation if you are not making those payments. And like I've indicated, payment will be compulsory. You can't just avoid the HECS debt forever if you're actually intending to earn an income. So that in essence is how payments work. In many times, it will be done automatically, but you can make voluntary payments. And there is a clear incentive to make voluntary payments. And this comes down to the issue of ballooning debt. The idea that the debt increases over time due to indexation. So say, for example, you are never earning above that threshold. Well, if you're never earning above that $51,550, then your debt is just going to keep increasing over time with indexation. It is going to be indexed to inflation analogously. So, for example, say the inflation rate is 5%, then your debt will increase by 5% in that year, effectively. Now, it is a little bit more complicated than that. The actual indexation amount is not the exact same as the headline inflation rate in Australia, but it is closely analogous. Now, this functions like increasing the debt with inflation. It also has some parallels to interest. So say, for example, you go out and you take out a mortgage, or you go to borrow to buy a car. Well, when you're borrowing, you have interest rates applicable to that, meaning you need to pay interest each period. Now, when you're making a repayment on a mortgage, you would typically be making a principal payment and an interest payment. The bank or your lender is going to set those payments such that you will pay off the debt within a certain amount of time, typically about 30 years for a house, maybe about 5 years for a car. This means those payments are always designed so you pay off the debt in full. With the HECS debt, that is not the case. As we saw, the actual amount of payment you make might just be 1% of the loan amount in that year, meaning that the payment is not set so that you reduce your debt towards zero, it's just set at that arbitrary threshold, meaning that you need to pay more of a payment if you're going to get the debt down towards zero, but that is a separate issue for the moment. Now, going back to the interest rate analogy, with a mortgage or with a car, if you do what's called capitalizing the interest rate, that would involve adding the interest to the total amount of debt. So if, for example, your interest were going to be $50 in that month, well, you would typically pay off that interest. That's what the bank would normally force you to do. However, in some circumstances, that interest might be capitalized, in which case it would be added to the total loan amount. And in that case, you're going to have an overall debt level that is actually higher. What implicitly is happening with the indexation is that interest is being capitalized, i.e. added onto your total loan amount each year. Now, there is some nuance with that indexation. Like I said, it is analogous to the inflation rate, but not the exact level of the inflation rate. It is similar to it. Furthermore, the indexation occurs on the 1st of June every year. So if you're going to make a voluntary payment, you would always want to make sure you get it in before the 1st of June, not after. Because if you make the payment after, you will have now just paid off the interest effectively that you had accrued. Rather, you want to make the payment before, so that when the indexation occurs, the indexation is going to be from a lower base. For example, 5% of $4,000 is going to be less than 5% of $5,000. So you pay it off before the indexation kicks in on the 1st of June. So say, for example, you've got a HECS debt of about $50,000. Well, say you get that at the end of your studies. Then that could increase near exponentially depending on what the inflation rate is. And we've seen some of this over the past year or so, where inflation rates have been very high and people have been hit with indexation and they've wondered why the debt has seemingly skyrocketed during that year. Now, the purpose, at least the policy purpose as stated for this, is to try to deter people from inflating away their debt, to deter people from just leaving their debt forever, and to encourage people to pay off the debt earlier. It's effectively a stick with which to whack people over the head to induce them to pay off the debt earlier than might otherwise be the case. Now, to see how this might work, suppose you start with a $50,000 debt, and suppose it is indexed at 2%, and you know it is going to be 2%, which is a big unknown to be clear, but say you know it's going to be 2%. Well, then after year one, your debt is going to go from $50,000 up to $51,000, because you now have that 2% indexation. Now in year two, say it's another 2%, will it now be indexed again, and it'll go to $52,020. Again, your debt is increasing. In general, there is a formula to calculate how much debt you are going to have after a certain number of years, assuming you know what the inflation rate or the indexation rate is going to be, which again is a big assumption, but you could potentially make some guesses because the Reserve Bank's target inflation rate is between 2 to 3%. So in that case, the formula would be you take your start amount, so your $50,000 in this case, you multiply it by 1 plus the expected inflation rate, and put that all to the power of the number of years. Now this of course assumes you know the inflation rate or the indexation rate in advance, which you won't necessarily know. But like I said, you could make some estimates to come up with an estimation of how much your debt would be after a certain time period. Now so far we've been talking about this indexation, so let's put some hard numbers onto this. How much is the indexation actually going to be? Well, like I've said, it occurs on the 1st of June every year. And on the 1st of June every year, your HECS debt load is going to increase by a certain amount. This, like I've said, is similar to the inflation rate. So for example, in 2023, the indexation rate was 7.1%. In 2022, it was 3.9%. Before that, it was 0.6%. What you can see is the indexation rate varies a lot over time. Now, before the most recent couple of years, the indexation rate had been around 2% or a little bit lower than that. Hence why people hadn't really noticed it. The indexation rate had been low relative to mortgages or to car loans, and in particular relatively low compared to unsecured loans. Therefore, people had treated this as a relatively low interest rate loan, and people hadn't really paid that much attention to the indexation. However, when the indexation is 7.1%, people absolutely do pay attention to it. Hence why we've seen the outcry that has occurred recently. Now this means the debt would increase by 7.1%. If you had a $10,000 student loan, well, it would then become $10,700 after the indexation. So you need to be very careful of this because it will impact your payments. Now, like I've said, the indexation rate is similar to, but not quite the same as the inflation rate. So for example, that 7.1% indexation in 2023, that was actually a tiny bit above the inflation rate. The inflation rate was actually 7% at the relevant time, because the indexation is calculated as at March of that year. And the actual calculation for it is you sum up the price index level for all of the 4 quarters during that year up until March, and divide it through by the price index level in the 4 quarters in the prior 12 months. So it is like inflation, but it is not the exact same as inflation. So the inflation rate in March was actually 7.0%, not 7.1%. However, sometimes that can be beneficial to you. For example, in 2022, the indexation rate was 3.9%, but the actual applicable inflation rate was about 5% at that time. So whether it's beneficial or not, how they're calculating it will vary a little bit time to time. So what then does this mean for repayments? What this basically means is you should pay off your debt as soon as possible. It is better to spend the money on a HECS debt than on frivolous other things. If you pay less than the inflation or the indexation amount, you are going to see your debt load increase. For example, if you only pay 1% of the debt every year, but the inflation or indexation rate is 2%, then you will not have fully paid the indexation. You are going to pay less than your debt will increase by. So let's take an example. Suppose you start with a $50,000 debt and you pay 1% of that. So you pay $500 before the 1st of June deadline. Then you'll take it down to $49,500. But then if you've got 2% indexation, it will now go all the way back up to $50,500. So you actually have more debt than you started with, even though you made a payment. And that's because the indexation was more than what your payment rate was. And therefore you need to make sure that you're paying more than the indexation would be. There's a clear incentive to pay more than the required amount and to do so earlier rather than later, which enables you to make a bigger dent on the loan. And this basically means that if you're not paying off the HECS debt as soon as possible, then your debt is probably going to keep increasing, which is not necessarily ideal for people who are earning relatively low incomes and can't necessarily afford to pay more of that debt. Now, there is a bit of caveat to paying it off earlier. For example, if you've got credit card debts, well, the interest rate on the credit card debts is probably much higher than the HECS debt, so pay off the credit card first. Similarly with the car loan, you would put the money toward the car loan before the HECS debt, obviously after making the required payments. Mortgage rates might also be higher than the HECS debt rate, but again, that will vary a bit over time. Typically, the mortgage payments and the mortgage interest rates are higher than the indexation rate, but again, in the most recent year, that has not necessarily been the case. So exactly how you're approaching it depends on exactly what other debt you have. You typically devote your money to paying off the most expensive debt first, and then really chip away at that. Chip away at the credit card that's on 20% interest first, and get that out of the way. We should of course consider some complications and some nuance when you were considering paying off your HECS debt early. And in particular, these come up when you were saving to go out and buy a house. So say for example, you're looking to buy a property, you will need to make quite a bit of upfront payments. So for example, you need to be able to pay the deposit and the stamp duty. The deposit is typically around 10% to 20% of the purchase price. The stamp duty is around 5% of the purchase price. So say you're buying $1 million apartment or house. Well, here you've got a 10% deposit, $100K, 5% stamp duty, which is $50K, $150,000 upfront. Now, there can be some complications on this. Stamp duty is not always applicable, but it often is. The deposit might need to be higher and might be lower, depends on the circumstances. But let's go with $150,000 upfront on that $1 million property. Here you have borrowed $900,000. Now we add a complication. Say you've got $50,000 in HECS debt. Well, that $50,000 in HECS debt has a couple of impacts. It will impact how much money the bank is willing to lend you, because the bank will consider your total debt situation and your income when assessing how much it is willing to lend. So say, for example, it is only willing to lend you $900,000 in total. Well, then it might consider the $50K in HECS debt and reduce the total borrowing capacity to $850,000. Of course, there are some nuance in relation to this when considering serviceability. It's not that quite clear-cut, but it gives you an idea. The other complication is that say you paid off your HECS debt early, you need to consider, well, what does that leave you with in terms of upfront cash payments? How does that impact your deposit and your stamp duty? So let's go back to our situation. Say you'd managed to save $150,000 and you were considering buying that $1 million house. But you were also considering, do you pay off your HECS debt early? Take $50,000 and then pay off the HECS debt, and then go out and borrow. Well, in that case, you're left with $100,000 for upfront payments. That means you would only be able to buy something that is about $666,000, i.e., the total value of the property you can purchase is now significantly lower. That may or may not be a good thing depending on how much you are struggling with the debt and how much you would have struggled with the debt. Furthermore, you need to consider how long will it take you to save up that additional $34,000. What I'm getting at here is that you need to consider how long will it take you to save up to get that deposit again versus how easy or not is it to borrow with the HECS debt. That's something that will depend on your personal circumstances. I've also indicated you need to consider, is there more expensive debt that you should pay off before paying off the HECS debt, such as credit card debt? Again, a lot of that will depend on your personal circumstances. What I'm getting at here is there isn't necessarily a one-size-fits-all answer to whether and when you should pay off the HECS debt early. It will depend on how much you were struggling with the debt, how much additional debt you were looking to take on, whether you're looking to save up right now to buy a house, and how long it would take you to re-save that deposit if you pay it off now or pay off the HECS debt now. You need to consider your personal circumstances, and a lot is going to be person-specific. And in any case, I hope that's given you an overview about how HECS debt works, the way indexation works, and the incentives involving payment. If you've got any thoughts about the system or any thoughts about how it works,